It's my honor to have this opportunity to present our paper. So our paper is digital footprints as information collateral for debt collection. I'm Jianlei Han. I'm from Macquarie University. My co-authors are Lily Dai from University of New South Wales, Jing Shi also from Macquarie University, and Bohui Zhang from Chinese University in Hong Kong. So first, the motivation of our paper is to address a global exploding issue, debt delinquency. So the left figure, we show that the delinquent rate of loans in US, about 10% of outstanding credit card debt was more than 90 days delinquent. In China, which is a developing country, the outstanding delinquent loan is growing rapidly in recent years. So from the right figure, we can see that the delinquent amount almost tripled in the last 7 years. So when a loan is delinquent, the lenders need to initiate the process of debt collection. So on the other hand, the demand side always faces a challenge to get personal loans as the information asymmetry is high. So for a small amount loan, it's always costly to acquire information. So traditional banks, their personal loans usually are backed by income or collateralized by properties. So for example, the car loans or a mortgage. So the lenders can recover the loan if they default by selling the property. So fintech lenders, they have advantages because they have technology to collect more information than traditional banks. So they require no physical collateral or income-related proofs for providing personal loans. So that the market share is growing rapidly to meet the high demand. So for example, in China, we have Alipay and Check Later, which is already 150 billion market cap. And in Australia, we have Afterpay and ZPay. So these are all fintech lenders. So in our setting, we define collateral as a more generalized term. So for example, this graph shows that for traditional collateral, such as a house or a car, they can be sold to recover the debt. But you cannot sell the digital information directly. So the collectors, they use digital collateral to increase the collecting successful rate instead of selling anything. So in this way, we say the digital footprint is acting as a similar function as a collateral. The existing literature shows that digital footprint can be used for screening the credit quality of borrowers, therefore helping the loan approved decision making. For example, we have Berg 2020 shows that the usage of mobile type can be used to improve credit score modeling. Argo's working paper showed that the digital footprint, digital information entirely can improve the default forecasting by using machine learning techniques. So our study is from a different angle, which shows that this digital footprint can be used as collateral in debt collecting process, given that the debt is already at delinquent. And consequently, such collateral can improve the financial inclusion. So how do the digital footprints work? In our setting, we consider two specific types of digital footprints. One is a mobile, the borrower's mobile frequent contacts. The other one is his delivery address for online shopping. So if a borrower is at delinquent or refuse to pay, the lender may reach to the borrower's frequent contacts, who may be relatives or friends. If the lender has such information, then such social pressure can push the borrower to repay. We name this channel as social capital channel. So if the lender has the borrower's physical address through his online shopping records, They have the possibility to send out a lawyer's letter or reach the local police office or neighborhood committee to motivate the borrower for pay. So we name this channel as physical location channel. Taking these two channels together, we give a specific example how the digital footprints can be used for debt collecting. So to prove the collateral function of digital footprints, we do three groups of empirical tests. The first one and the major one is that the delinquent borrowers with the information of mobile frequent contacts or delivery residential addresses have high likelihood of repaying when they receive a chasing call. Secondly, we show that such information helps improving the loan approval rate, acting like collateral. Lastly, we show that this information we use is not indicating an ex-ante good credit quality, which isolates the effect of digital footprints on debt collecting. Oh, sorry. So before we go to the detailed data, I'd like to show you the background. So a top fintech firm in China started this consumer loan production from 2017. They set up terminals in retail stores across major cities in China. The borrowers apply through the terminal when they want to buy a mobile phone, an electronic bike, or other things. The whole process is very fast. It only takes about 10 minutes. Then they will receive the outcome, and if they success, they will receive the money. So I use this diagram to describe the whole process. So the first step, the borrowing applicants provide their national identity card and mobile number. So these are basically everything you need to input in the terminal. The lender has a database which is purchased from third-party data providers. The data includes mobile call logs, online shopping records, other platforms' loan records. So the lender matches the database with the borrower's national ID and mobile number. Then they conduct analysis. Then they make a decision to approve or reject the loan. If the loan is successful, the borrower gets the money, and they need to do the monthly repayment to the lender. So if the borrower delinquent, the lender will make chasing calls to chase the debt. So this graph shows the debt collecting process. From three days before the due date, the borrower will receive reminder messages each day from day -3 to day 0. After the due date, if the borrower delinquent, on day 4, the company will make the first call to the borrower and perhaps his frequent contacts. So if unsuccessful, the company will make further calls on day 16, day 31, day 61, and hand over the case to debt collecting agencies if this process doesn't work after day 91. So we get the full data set from the starting of this product in July 2017 until November 2019. It includes over 236,000 of loan applications spread over major cities in China. 97,000 approved loan contracts, 41,000 delinquent loans. We also have the detailed repayment records of all loans, including pay amount and paying time. So we also have the applicant's characteristics, including age, gender, province, the Alipay account balance, Tencent risk score, lending history from other lending platforms, and some unstructured data like mobile call logs, online shopping records. So we'll start from the delinquent loan sample. So we construct one main dependent variable, which is paid T. It is a dummy variable. It equals 1 if a borrower makes a repayment on day T. The T denotes the number of days after the due date. So the variable we use to proxy the digital footprints are also dummy variables. So contact is a indicator variable which equals to 1 if the borrower has at least one frequent contact in the database. So this contact should be non-commercial number. It should have more than 10 calls with the borrower, and these calls should be more than 20 seconds. Another dummy variable is address. It's an indicator which equals 1 if the borrower has at least one eligible delivery address in the database. We exclude non-residential address. For example, those as a convenience shop or post mailbox. To be noted here, the existence of the frequent contact or delivery address is not depending on the choice of the borrower, but mainly depending on the data provider's coverage. So this is a brief view of the summary statistics. So we have 41.3% of loan applicants get approved, 42.7% approved loan experience delinquencies, and 61.9% of delinquent loans get repaid within the first 6 days or the first chasing call. So we conduct a difference in difference approach for empirical test. The treatment sample is borrowers with frequent contacts or delivery address, while the control sample is those without such information. The pre and post periods are defined in a 6 days window before and after the delinquent borrower receiving debt chasing call. So this graph shows how we define this event window. So we match the treatment sample and the control sample by a propensity score matching method using the characteristic of loan and also the characteristic of the borrowers. So I use a figure to show show our baseline results. So in this figure, panel A is for the first chasing call on day 4, and panel B is for the second chasing call on day 16. So the blue line denotes the treatment sample, and the red line denotes the control sample. So on day 4 and day 16, we can see there's a spike of repaying probability. That means that the chasing call is useful, and the usefulness is significantly higher for the treatment sample. And we find a similar pattern if we use a delivery address as the proxy for digital footprints. Similarly, we see that for the treatment group on the chasing call day, they have significantly higher repaying likelihood. So to do a formal test, we run a multivariate regression model. So in this model, chasing is a dummy indicating pre and post for the chasing call event. And contact or address is the treatment dummy. It equals 1 if it belongs to the treatment group. So to make our model as strict as possible, we control the borrower's individual phase effect, day phase effect, and also interact the chasing dummy with all control variables. So the coefficients of the interaction terms are all significantly positive. So the results suggest that the digital collateral plays an effective role in facilitating debt collection. So next, we want to test the 2 economic channels, social capital channel and physical location channel. We conduct a subsample analysis to provide evidence of these two channels. To proxy the social capital, we construct two measures from China Household Finance Survey in 2017. So the first one is social spending. So in China, people need to spend money as gifts to their relatives or friends when they attend some traditional events like wedding ceremony or funeral. So higher average social spending means higher social capital in the, we have this data at province level. The second proxy we use is the veneration ancestor attending frequency. So higher value of this measure means people in this area are more bonded, indicating a higher social capital. For the physical location channel, we also constructed two proxies. The first one is geographic distance between the borrower's city to the firm's headquarters. We expect a longer distance. The borrower will be more shocked psychologically if the firm knows their specific address, therefore generating a high effect. The other proxy is the litigation confidence from the survey data. So higher confidence indicating higher litigation efficiency, and the address information might be more useful. So this table shows the subsample test results when we split the sample based on the median value of the two social capital proxies. So we can see that for the provinces with higher social capital, the coefficients are significantly higher. So the results tell us that when the potential loss of a borrower's social capital is more substantial, the borrower would be more motivated to repay the loan. So this table shows the subsample results when we split the sample based on the physical location proxies. So we can see that if the physical distance is longer and the litigation confidence is higher, the delivery address information has a high effect. So a potential concern is that the existence of digital footprints we use is indicating a higher credit quality. To rule out this possibility, we use a larger sample that is for all approved loan contracts to show the relation between digital footprints and the delinquency likelihood. So this table shows the results. We find that the existence of this information do not indicate a lower delinquency likelihood, sometimes higher. So for contact, we see a higher delinquency rate. So lastly, we use the largest sample, including all loan applications, to test the relation between the digital footprints and the loan application approval likelihood. So in traditional bank loans, if you have a collateral, then the application approval rate will be higher for the same credit quality. So in our test, we also find the same relation. The existence of the digital footprints significantly increase the loan application successful rate. So therefore, we provide the evidence that including the collateral can increase the financial inclusion. So finally, let me conclude the paper. We show that the information contained in borrower's digital footprints can be used for debt collection. So from the perspective of the customer, the digital footprints can improve their financial inclusion. So all our main task of the paper is to show that the digital data has value to the fintech lenders. So the fintech lender can subtract value from customers' data. It leaves an open question, who shall own the data and to what extent we can use the data. Thank you. Comments and suggestions are greatly appreciated. Thank you.
Thank you very much, Jianlei. The discussion is Wan Tang from LSE.
Yeah, I'll stop my screen.
All right. Can you hear me?
Yes, perfect.
Thanks, that's great. Let me first thank Alberto and Michael for inviting me to discuss this very interesting paper. Jianlei covered all the main results of the paper, so let me just do a very quick summary. The main result is that digital footprints facilitate debt collection. If we compare two groups of delinquent borrowers who are identical and receive similar loans, but one group have more than one frequent contact, which is represented by the green line on the graph, while the other don't, then the recovery rates are significantly higher for the first group of borrowers. Similar result can be found when we compare borrowers with online shopping delivery address available to the lender to those without such information available. The empirical analysis, including the matching procedure and the mechanism part, is performed to a very high standard. As a person who also worked with Chinese fintech data, I paid additional attention to the summary statistics and find that borrower demographics and loan characteristics to be very similar to what I saw in my data. So I think this is reassuring, and I believe the sample is fairly representative. Moreover, the paper is very well written, and it was truly a pleasure to read. Today, I'm going to focus my discussions mostly on the big picture questions. First, given the role of digital footprints in debt collection, we may want to take one step back and try to understand who have digital footprints used by the lender and who don't, and what does that mean for financial inclusion. Second, I agree that the results suggest the use of digital collateral may improve financial inclusion, but in order to make a policy recommendation, other factors need to be accounted for, and I will try to sketch a simple framework for that purpose. Last, there are some parallel work on very similar questions, which, by the way, is evidence that the authors are after very trendy and important topics. So I would suggest some additional analysis that the authors could take on to differentiate their paper a bit more. And last, if I have time left, I will mention a few specific questions I have on the empirics. So my first comment is on selection. In empirical studies, we often try to control for selection. But this paper provides a nice example where we actually want to understand where the selection issue comes from and focus on selection itself. To get to the nature of the selection issues in the default stage, we need to go back and start from the very beginning of the application process. In the application stage, borrowers with digital footprints and borrowers without digital footprints are already different. Let's assume a fraction of the population are sophisticated enough to understand that the lenders use digital footprints in screening and debt collection. In equilibrium, we will have two types of consumers decide to apply. First, those who are not concerned about their data privacy. And second, those who do not leave tons of digital traces online so that they know there's nothing to be exploited by the lender. As a result, promoting the use of digital collateral may disproportionately exclude privacy-concerned borrowers who could be credit-worthy. In the second step, once the applications are completed, the lender screens borrower applications based on the information collected. Keep in mind that in our setting, the lenders only collect national ID and mobile phone number from borrowers directly. All other data are extracted from third-party data vendors. And naturally, borrowers with and without much digital footprints are going to receive different screening outcomes. In particular, those with a thin digital profile will be less likely to get a loan on average. In other words, conditional on getting a loan, borrowers without digital footprints have to be better in other dimensions. So in some sense, we can view digital footprints as substitutes for more conventional information such as income in the underwriting process. Again, what this implies is that borrowers without frequent contact or delivery address available would be disproportionately rejected than those with such information. If we want to argue that the main benefit of the use of digital collateral is financial inclusion, we have to be careful, because the financial inclusion here only applies to the people with sufficient amount of digital footprints. So this points to a limitation of the use of digital collateral. The scope of financial inclusion depends on whether lenders could identify the information that effectively disciplines borrowers, but at the same time does not discourage too many privacy-sensitive applicants. And this information also need to have a high coverage among all applicants. To give you a number on the coverage of the frequent contact, 35% of the delinquent borrowers in the sample do not have such information available. Without knowing the same number for all potential applicants, which may be even more than 35%, it's really hard to assess the degree of financial inclusion that comes with the use of digital collateral. Now, coming to the last step, which is default, this is where the authors perform the matching procedure. It is clear from this previous discussion why it is necessary for the authors to do this. It's because borrowers with digital footprints are more likely to be better in other dimensions. And this is indeed what the authors find. Before the matching, borrowers with digital footprints are actually more likely to default. Therefore, the matching is called for. Now, summing up all these different layers of selection, what I really want to say is the selection or the differences between the borrowers with and without digital footprints at each step of the borrowing process is worth more attention and discussion. So for one thing, we know that the use of digital collateral may discourage privacy-sensitive applicants who may be credit-worthy, therefore restricting the potential of financial inclusion. For another thing, borrowers without the specific digital footprints, such as frequent contact and delivery address, are disproportionately screened out by lenders. And we just don't have enough information to assess whether lenders are using the right pieces of digital footprints in terms of how effective it is in facilitating debt collection and what's the coverage among the majority of applicants. So, having set the stage, I think I'm in a good position to further develop the first point and discuss the policy implications that the paper alludes to. The authors did devote some space to discussing the potential privacy issues and concluded that the use of collateral can be legitimate if the collection and the use of personal data are in accordance with the country's laws and regulations. I think there are probably other aspects we want to take into account and other benchmarks to rely on to make policy recommendations. For example, do we know whether borrowers are aware of the collection and use of digital footprints? In this paper's empirical context, because the lender only asks for national ID and a mobile phone number, borrowers may be led to believe that the lender collects limited information from them. I wonder, in a counterfactual cases where the lender is fully transparent about the specific data items they collect and how they use them, would the results change? Would the implications on financial inclusion change? And that's an open question. And perhaps legitimacy is not the most natural benchmark to use, and welfare could be another. What would be a general welfare framework to think about the trade-off between privacy protection and financial inclusion? Here's my humble attempt. I think regulators need to take into account both the lenders and the borrowers' problems. For borrowers, what matters is the value of credit access and the value of personal data required to obtain such access. For lenders, what matters is the marginal benefit of collecting additional digital footprints, and the marginal benefit would depend on its impact on credit demand, on borrower risk composition, and also the impact on debt collection. And this paper focuses on the very last item, which is an important element of this framework. But as you can see, in order to have a complete picture on the welfare implication of digital collateral, there are these other 3 or 4 modules of assessment to be done. And this is a very ambitious goal, and I'm not suggesting the paper to do this. My hope is that the framework could help the authors to think more about how to link their empirical results to the policy debate. Now, my last major point is about the positioning of the paper. There have been some parallel work on the impact of social capital and the various debt collection tactics of fintech lenders on borrower repayment behaviors. Again, this just means these questions are very important and interesting. But perhaps one way to differentiate the paper a bit more from the papers listed above is to try to quantify the dollar value of digital footprints for the lender. The resulting dollar estimate from this quantification exercise will provide insights on the lender's problem in the welfare assessment framework presented on the previous slide. And how do we do that? It is actually forward. What is the lender's profit? It's equal to the gross return on lending, 1 plus R being the interest rate, minus the default costs, which depends on delta, the repayment probability, times theta, the recovery probability, summed over all applicants who are approved. And all these 4 red parameters are functions of whether digital footprints are available and used for an applicant. And this paper actually did analysis on all 4 of them by linking them to of digital footprints. So we should be able to compute the profit from lending easily for these 2 groups of borrowers and compare how much more the lender could earn with the use of digital footprint. Of course, it will be even better if the authors could collaborate with the lender to perform a controlled experiment in which we do not allow lenders to collect and use certain footprints of interest for a randomly selected group of borrowers. So I think I still have some time left. Let me then quickly touch upon a few specific points I want to make on the empirics. First, I was wondering if the authors observed the actual use of digital footprint. So here's why I asked this question. What the paper does is essentially the reduced form regression of a 2-stage least square estimation. We can think of the presence of digital footprints as an instrumental variable, and whether the lender uses digital footprint is the endogenous variable. And the final outcome of interest is loan recovery. The authors regress loan recovery on the presence of digital footprint, but the true IV estimate is actually equal to the reduced form estimate divided by the 1st stage estimate, which is how likely the presence of digital footprints leads to a use of that digital footprint. And we know that the 1st stage estimate has to be smaller than 1 because it's a probability. Therefore, the reduced form estimate is actually biased downwards compared to the IV estimate. And this could be discussed. Next, I'm curious about the heterogeneity in the recovery results with respect to borrowers' age, gender, education, and income. And I was wondering how this heterogeneity compares to that in some of the parallel work, which also looked at this aspect. And third, look at 2 pieces of digital footprints in particular, frequent contact and delivery address. I'm wondering to what extent delivery address can be considered as digital collateral. We know to get a bank loan, almost certainly we have to provide proofs of address to banks. So effectively, banks can use the same debt collection tactics based on the physical address of borrowers that this fintech lender uses. So for me, the definition of digital collateral becomes a bit hazy here, and some clarification would be very helpful. Another place where selection could occur and wasn't mentioned in the paper is the take-up stage. I'm not sure whether all approved applicants took up the loan or the authors did not use these observations in the final sample. But I find people's take-up decision to be very informative. So if we do observe take-up decisions, can we check whether people with digital footprints are less likely to take up the loan? This may be the case because, before taking up, they might just be shopping around and checking what's the loan terms. But when it comes to the real decision, the concerns over social capital or data privacy may dominate. And based on that finding, this selection may also inform us of who benefit the most from the use of digital collateral. So I have only one point to make, which is actually about the mechanism part. To test the social capital mechanism, the authors split the sample based on local law enforcement and veneration events. I suggest that the authors also control for economic conditions, because areas with more traditional values are also those areas that are less developed economically. Hence, factors such as their family wealth may also confound their repayment behaviors. Let me wrap up. All in all, this is a very solid empirical paper, and I think it would further benefit from a deeper discussion on the welfare implications of the use of digital collateral. And I look forward to seeing the next of the paper. Thank you.
Thank you, Juan, for a fantastic discussion. Jianlei, why don't you take a couple of minutes and respond to Juan while we see if there is any questions from the audience?
Thank you, Juan. Thank you very much for your great comments, especially in the selection issue and the welfare implication. So in the selection issue, we actually the point is that the borrowers, they might not even aware that what information, what kind of digital footprints can be captured by the company. So I hope that if the customer awareness, the usage of data will affect their decision. I hope this will not affect our results much, because those borrowers, they don't even know if what kind of data they left on the internet, and the implication, that's a very good point. We should think more about that. So overall, thank you for your wonderful comments.